Greetings, members, one and all of the Salivation Nation. Silver back up over $24 for no good reason. Let's explore. Yes, all the metals are in the green as the markets are coming to a close here on this Friday afternoon. Fascinating to see. And why is it happening? Well, because of what we anticipated, or maybe not anticipated. Essentially, there's no good reason why these metals are up. Because of what people thought was going to be coming out of the Fed meetings. We're going to look at a couple of articles here from Kitco. Gold price jumps above $1,800 as Powell says tapering could begin this year. We go through this article and talks a little bit about, this was posted earlier in the day, about this meeting, the July meeting here, a possible reduction of bond purchases. Powell said that it is likely to start happening this year. Likely, but of course there's no definitive action or any hint that it really will, just that it's possible, but anything is possible, especially in terms of the markets. And that is really why these metals went up, really for no good reason. At the FOMC's recent July meeting, I was of the view, as were most participants, that if the economy evolved broadly as anticipated, it could be appropriate to start reducing the pace of asset purchases this year, Jerome said. The Fed chair also balanced out all the impressive progress made on the inflation in the employment fronts with remaining Delta variant risk. The intervening month has brought more progress in the form of a strong employment report for July, but also the further spread of the Delta variant. We will be carefully assessing incoming data and the evolving risk. Even after our asset purchases end, our elevated holdings of longer-term securities will continue to support accommodative financial conditions, Powell stated. Going forward, macro data out of the U.S. will be key when it comes to Fed's tapering timeline, he said. Now, macro data will be the key. We'll find out. The central bank also reminded the markets that reduction of asset purchases does not mean that the Fed will be ready to start raising rates. Powell said that the Fed has articulated a different and substantially more stringent test for raising rates. We have much ground to cover to reach maximum employment, and time will tell whether we have reached 2% inflation on a sustainable basis, he said. Well, I think that we can pretty much throw off to the wind, because even if numbers come out show that it is reduced down from over 5% down to 4 or 3%, it's still well above 2%. I don't think that's going to happen anytime soon. When talking about inflation, Powell maintained his transitory view, noting that an overreaction to higher inflation numbers could do more harm than good. Well, I tell you what, I believe in what he would consider to be an overreaction. I think that would do more good than harm. We'll talk about that momentarily. The ill-timed policy move unnecessarily slows hiring and other economic activity and pushes inflation lower than desired. Today, with substantial slack remaining in the labor market and the pandemic continuing, such a mistake could be particularly harmful, he said. Powell also stated that inflation reacts to changes in monetary policy with a lag of a year or more. If a central bank tightens policy in response to factors that turn out to be temporary, the main policy effects are likely to arrive after the need has passed. We know that extended periods of unemployment can mean lasting harm to workers and to productive capacity of the economy, he said. In other words, maybe he's hinting that these shutdowns and even the threat of these shutdowns happening again with this new variant would not be a good thing. In the meantime, the Fed will rely on the incoming data to monitor inflation's progress. He stated that he still believes that job growth will continue and price growth will moderate. Central banks have always faced the problem of distinguishing transitory inflation spikes from more troublesome developments, and it is sometimes difficult to do so with confidence in real time. If sustained higher inflation were to become a serious concern, the Federal Open Market Committee would certainly respond and use our tools. There's that toolbox he talking about. Well, many people think that some of these board governors are tools themselves to assure that inflation runs at levels that are consistent with our goal, which is 2%, 2.5%. Really, essentially nothing new was said, which makes the statement more dovish than expected. Powell's speech just repeats that we already knew from the minutes of the July FOMC meeting, said Capital Economics chief U.S. economist Paul Ashworth. There was really a strong push among officials to kick off the tapering later this month, then surely Powell would have dropped a heavier hint today rather than just repeating what was in the July minutes. So essentially, it was no go. It was a nothing burger in this case. So silver kind of went up to $24 and gold over $1,800 for no good reason. And we have another article from Anna Golubova here from Kitco as well that talks a little bit more about this and where things are. And the gold market has not disappointed with Powell's comments. RJO Futures Senior Market Strategist Frank Jolly told Kitco News here as we get into the precious metals and their reaction to this. Much like equity markets, the gold market likes to see a continuum of easy money. I would hope that at some point we would begin to normalize rates and gold will be willing to embrace it at that time. Right now, gold seems still remains mostly contained into a range. We're mostly at the high end of that range as it now has broken above, and comfortably so, above $1,800. He noted that next week's price action would tell investors whether Powell's comments were enough to get gold out of the 1780 to 1810 range, where it has been stuck recently. It's already above there now. But if it does get up above 1820, he's not convinced that it won't fall back to 1750 or 1720 because of that sharp sell-off that we had in early August. The precious metal had a good recovery, and now it's waiting for some directions. Was Powell's statement enough to get us above 1820? The gold market will pay close attention to how the U.S. dollar trades next week, especially after a quick sell-off on Friday, which helped boost prices higher. And we have some things to look forward to next week. And I think it's really interesting to see how these are going to play with the prices of gold. It's filled with some important data. Biggest release is August U.S. employment report, scheduled for Friday. Market consensus calls are projecting for the U.S. economy to have added more than 700,000 positions. Monday we'll have pending home sales. Some people feel like the home market, housing market, has reached its peak and is starting towards a decline. Tuesday, we have the U.S. House Price Index, the CB Consumer Confidence Report. On Wednesday, we have the ADP Employment Report, and then ISM Manufacturing PMI. Thursday will be jobless claims, and then Friday, U.S. non-farm payrolls and ISM non-manufacturing PMI. All this will have an effect one way or another on the markets and kind of what the Fed would react to typically. But essentially, the prices psychology weighs in heavy on anticipation of what could be tapering. But right now, they're up. Silver is up over $24. Gold is comfortably above $1,800, pushing closer to that $1,820 level. Platinum is actually now above $1,000. Again, palladium skirting and flirting with that $2,500 level. And even rhodium went up today, and it could have been based off of this move. It's very difficult to kind of judge rhodium there. But nonetheless, this metal here, silver, is kind of the mover to watch because it has reacted much more sharply, which we come to expect with silver. That's going to narrow the gold to silver ratio. In fact, we look at the gold to silver ratio now, it is now 75.66, which is a number that we've not seen in a little while. And we did see it get closer to 80 to 1 when we saw these dips in the prices. But now, as recovery begins here, and we'll see if that continues into next week, well, it's narrowed slightly. I'd like to see it get below 70 again, but we may take a while to get there again. But silver is a metal that has perplexed us for quite some time. But in the end, the fundamentals really of the metal have not changed through the periods of spikes. And in fact, now looking back, looks like $28, around $28 level that we saw earlier this year, may have been the top. Although I am sticking with my prediction of between $30 and $35 to where it will touch before maybe coming back before the end of the year. But that's looking less and less likely as the year progresses on here. We're well over halfway through it. Silver, though, depending on how and when you buy, you are protected because it will stand against the dollar, which is by design, will lose value each year. The Fed just wants it to lose at its rate, not by the natural rate that we're seeing now because of many of their policies that are causing the dollar to decline in value to the tune of over 5% now. Silver, though, there's only so much that can be produced per year, especially when you compare it to the dollar bill, you all. Well, I've done videos about that. It's called the debt clock and silver and the debt clock, talking about how many ounces of silver that are mined per year globally versus the amount of dollars that are printed or digitized or created each year under the Federal Reserve System. There we go. So fascinating. There's your end of the week report here on the prices for gold and silver. And essentially, it's much ado about nothing, but they are up. So I hope you enjoyed this video. Let me know what your thoughts are in the comment section below. Would like to extend a multitude of gratitude to you all for taking the time to watch, and encourage you to please rate, share, comment, and subscribe.